Good afternoon, everyone. This is Valerie Saunders with the National Association of Mortgage Brokers, and thank you very much for attending today's webinar, Non-QM in Action, Investor Cash Flow and More, presented by Angel Oak Mortgage Solutions. Without further ado, I'm going to turn it over to John Wise with Angel Oak.
Thank you, Valerie. Appreciate the opportunity to be here today. First and foremost, just want to say thank you, everybody, for attending. We're excited to do a deep dive today on our investor cash flow product, sometimes popularly known as Dscr. We're going to do a deep dive, and we're excited to jump into it with you. I do want to do a couple introductions first before we get started, so you know who you're dealing with. I am John Wise. I am a VP of Sales for Angel Oak Mortgage Solutions up in the Northwest region of the United States, and I'm joined by two incredible AEs on my team up in the Northwest, and both of them are. I'm not gonna date them, but they both have a long history in the mortgage business. And Jeff's got more hair than I do, but not much. But we're excited to be with you. I'm going to have them do their own introductions. Julie, you want to go ahead and introduce yourself?
I'm Julie Gregory, AE in the Bay Area. I will date myself. I've been in the business for about 40 years, so done a lot of different things, but I love to help people with their loans. So
good. Jeff, how about you?
Thanks, John. Yeah, Jeff Ogden out of the greater Sacramento region. Been doing this for about 25 years. So yeah, we've got a lot of experience in front of you, fortunately or unfortunately. So there you go.
No, it's why we exist, right? To serve other people. You know, the great thing about the mortgage business, it doesn't matter whether or not you're in the retail business or in the wholesale business or correspondent. You know, we're all here to accomplish the same thing, and that's to increase home ownership in the United States. And so it's great to be with everybody. You know, so before we get too far into this, I am going to launch a quick poll because I'm interested in some feedback from you guys. You guys get an opportunity to tell us a little bit about whether or not you're in the non-QM business. So we're gonna do a quick poll, just asking how many of you have completed a DSCR loan in the last 12 months, and just appreciate your participation in this. We're already getting some incredible feedback from. So just wait just a couple more seconds. Great feedback. Thank you so much. You guys are incredible. We've got almost 70% have participated so far, slowing down a little bit. So I'm going to go ahead and close this, and I'll share the results with everybody. I assume you can see this. So 76% of you have not closed a investor cash flow loan in the last 12 months. And you know, these numbers continue to increase. This is one of the reasons why we're incredibly excited about the non-QM space today, because if I would have done this poll maybe 6 months ago, these results were more like 10% had done a DSCR. So we're seeing an increased use in the product, and it's because people like you guys are educating yourselves and showing up and learning about the product so that you can better sell it to your customers. And so this is we just think it's an incredible opportunity for us. And I'm just one other thing that I want to point out before we jump into the details of the program. You guys don't really want to hear from me. You want to hear from Julie and Jeff. But you know, one of the reasons why we believe this product is growing like crazy is because about 36% of the total housing units in the United States today are owned by investors. They are rental units. Of the 36% of those units that are owned, that are rental properties, about 70% of those are owned by individual investors. These are your potential, either your current clients or your potential clients. That 70% represents about 10 to 11 million individual investors who are acquiring and or currently managing investment properties today. And this is the product that we're going to talk about today is exactly for those borrowers. So we're going to get into to product detail. We're going to get into the process a little bit. We're going to get into how to market yourself, and so let's kind of jump into it. Jeff, do you want to kind of take us through and by the way, I'm on our website. Any of you can access this at any time. It's angeloakms.com, and we've got a great access to programs, to highlights. So if you want any more information, you can always come here. But Jeff, why don't you take us through a high-level overview of the investor cash flow product?
Okay, so for now, the poll looks like it's still up on my screen, so I'm not sure if that.
Yep. There you
Okay,
go.
there we go. Got it.
Thank
Got
you.
to see my pretty face. So basically, the gist of the program, it is a true investment property program. And in doing so, what we are able to do as a business purpose loan, technically, that a non-owner occupied loan would be, we are allowed to calculate income or come up with an income in an alternative way that doesn't require us to meet the ability to repay rules. And the way that we do that is that for a borrower that owns their own current primary house, and that is the key to this whole thing, is that the borrower has to own their own primary residence or have a good logical explanation of why not, but 99.9% of the time we have to own our own primary residence. What we're able to do is take the rental income from an investment property, and we are able to use that as the qualifying income when comparing that to the payment on the home. So the Dscr, which is the debt service coverage ratio, is I have a rental income at, let's say it's $2,000. And as long as my payment is less than $2,000, then that meets our requirement as far as the coverage ratio on that property. So what we're able to do is take that $2,000, compare it to a $1,900 payment, and that qualifies that borrower for the loan. So that's the kind of 30,000 foot level of what the program's about. Now, it certainly gets into more details where we look at the properties themselves and the quality of the properties and square footage and things of that nature. But just as a high level overview, that is how we qualify based upon that. I don't know if you have any other, you want me to go any further on that, or?
Yeah, no, that's good. I mean, I think people, you hear about these in the market all the time as DSCR loans, but really what they are is what the title of the product is, which is a cash flow loan. And the income that we're using is based on the cash flow of the subject property rather than the borrower's income and employment.
So basically we have three different ways that we can do it. We can do it as a purchase transaction, where the rental income itself will be determined by the appraiser. So we will get a comparable rent schedule, and the appraiser will tell us that a certain property can rent out for $2,000. And again, if our payment is less than $2,000, we're good to go. We can do it on a rate and term refinance, and we can also do it on a cash out. So there's lots of different kind of opportunities. And the way that I see it, this program is great for you as a loan officer, to where this opens all kinds of doors for you into different types of people that own a lot of rental real estate properties, and they're in hard money loans, and they're paying 8 or 9% right now, and they're looking to either lower that payment or to get some cash out, to where they can not only get a lower interest rate but also get cash out to go buy more properties. So I mean, opportunity wise, this is a huge door opener and starting conversations with people that you previously probably weren't having. Just because if you look at the scope of, like John had said, 36% of the properties out there are owned by investors. If you can go find those people and start talking about this program, because inevitably they're going to have relatively complicated tax returns, and they're not going to have access to be able to qualify for these loans on the Fannie Mae, Freddie Mac standard programs. You look at putting them into a program where all we're asking is what's your rent and what's your payment, and do you have 6 months reserves? That's a pretty simple way to do these things. These are probably some of the easiest loans that are gonna be out there.
Yeah. So Pauline asked a question. It might be interesting response. Julie, is the DSCR considered a commercial loan?
It's not considered a commercial loan, but it is basically like a commercial loan because you're looking just at the cash flow of the property.
Right. And Jeff, what's the max LTVs and loan amounts?
So we will go up to 80% LTV on these. Our loan amount is going to go up to 1.5 million. At 80% LTV, we do require a 640 credit score. But at the same time, we're able to go, lower on the credit score and still do an 80%. But the minimum credit score on the program is 600.
Okay. And at 600, max LTV is what?
70%.
Okay. Okay. And so 80% max. And Jeff, so you had talked a little bit about the property needing to cash flow. We have other options when they don't cash flow. You want to get into that just for
correct. So the 1-for-1 is $2,000 in rent, $2,000 in payment. That is a 1-to-1 ratio. If you are greater than whatever the rent is, that you will qualify for the 80% with no issues. We have a window of 99% to 85%. So in that instance, it would be a $2,000 payment, and your rent is only $1,700. So it's inverted where it's 0.85. We can still do that loan for you. We will do it with a minimum of a 700 credit score. We can still go up to 80% on a 0.85 Dscr comparison. Even if you don't have that 0.85, let's say your payment was $2,000, but your rent only came in at $1,500, we can still do that loan for you. We will lower your LTV down to 75%, and as long as you have a minimum 700 credit score, we can still do that loan for you. We will add a quarter to that rate. So the rate's going to be a little bit higher because our risk is obviously a little bit higher. But there's all kinds of options. Basically, at 700 credit score and 75% LTV, you have a loan that we can do for you, irregardless of what the DSCR ratio is.
Yeah. Yep. So essentially, if the property cash flows, positive cash flow, no restrictions on the program, max 80% LTV based on the credit score. No limitations. If the property loses a little bit of money every month and your DSCR is still 0.85 or higher, in between 0.85 and 0.99, we can still go to max LTVs as long as your credit score is 700 or higher. Or you can have a property that loses money every month, and we don't at that stage, as long as you have a credit score of 700 and max LTV, Jeff, is 75%, we don't care what the debt service coverage ratio is.
That's called our no DSCR option.
There you go. Okay. All right. So one question popped up here: for rate and term or cash out, do properties need to be leased? Julie, you want to take that one?
On refis, they do have to be occupied by a tenant. We don't necessarily look for the lease, but the appraiser is going to let us know if it's occupied or not, and it does have to be occupied.
Yeah, so for rate and term or cash out, it does have to be occupied. The other question, another question popped up here. Great, thank you very much for all these questions. This is why we're here. We want to get as many of these answered as possible. Let me just say. So this says, if the investor is buying a property that has never been rented, does Angel Oak use the fair market rent or the prevailing well, Julie, Jeff, why don't you take that one? So if you're buying an investment property that's never been rented, how are we going to determine rental rates?
So in ordering a full investment property appraisal, the appraiser will give us an opinion of what that unit or units will be able to rent for. And that's the number. We are going to use 100% of the appraiser's opinion of what that unit would rent for. So, I mean, irregardless of whether it has or has not, the appraiser will come up with a number based upon other rentals in the area and comparing, kind of what the going rent rate is for that area. And we will use 100% of that number that the appraiser gives us.
Yeah, perfect. So we're going to go off the 1007 from the appraisal.
Correct.
Yeah. Okay. So great questions coming in. We still have some more. I'm going to get to those in just a second. But one of the questions that comes up all the time is, and this is kind of a non-QM thing, that people are afraid of non-QM. They're not exactly sure how to process these loans, and they're scared. And so Julie, can you take a minute to to talk to people about what an application should look like and how it's different from a regular full doc agency loan. Any details there that you could share with the audience?
Well, on the investor cash flow program, you're going to feel like you forgot how to process a loan because there is no income, there's no employment. You're going to put the assets on there, which we do require enough, obviously, for closing and 6 months reserves. You're going to put their liabilities on there. You're going to complete the REO with all the other properties, but we don't need anything on those other properties as far as lease agreements or anything like that, but they do have to be listed. And then basically your details of transaction. So it's a pretty bare loan out. And I think it throws people because they're like, wait a minute, you don't want anything on there? We don't want anything on there.
Right. Yeah. And hey, Jeff, you had a transaction the other day that I think is important to share with people. A person who owned a significant number of investment properties. What did that application look like for you?
So this individual, in total, between his personal, his LLC, and his business, had about 227 total properties. We only were concerned, and we only concern ourselves with what the borrower is personally liable. So that number really came down to about 50 or so that he had on his credit report. We do need to, as Julia just said, list on the application the property that the person is liable for personally, and then the associated mortgage with that. And we do require a 12-month payment history on that mortgage. So there is a little bit of paperwork that needs to potentially be done if that loan is not showing up on the credit report and it's a private mortgage. We're going to have to get canceled checks and things of that nature. So there is a little bit of documentation that is required to show all of the mortgages that are being paid. But this individual, had 5 loans that we're doing for him. All were hard money loans at 9%. We're significantly lowering his interest rate, allowing him to go get cash out, and I assume he's going to go buy more properties with that. But those are the type of individuals that I see as the biggest opportunity in this program, because not only can you get in with them to do those homes, but you can also get in potentially for the purchases on the other side, all kinds of, and inevitably guys who own that many properties, they know people that own that many properties as well. So it's a referral source for you that's saying, hey, John Wise can come over and do this loan for you because he just helped me with these ones. And I get every day, a guy that is doing a loan and knows somebody who else is doing that same type of loan. So on our loan itself that we're doing for that borrower, the 5 of them, Julie had mentioned the 6 months reserves. That is 6 months reserves only on the subject property that we're doing. So I do not need 6 months reserves on all 67 other properties that he has. Now I'm doing 5 of them, so I would need 6 months reserves on each one of the 5 that I'm doing. But the good thing is getting to count for the reserve requirement. So it's kind of a no-brainer when it comes to just documentation of that. It's just your REO section and your application need to be accurate, because that's the only way that we can truly tell kind of what the intent is of the borrower.
Yeah. So a couple things just to highlight from what you're talking about. There's no limit to the number of properties somebody can own. We also have no limit as to the number of properties that can be financed. Obviously, that's a huge difference between us and the agency world. So one of the other questions that come up in that definition is you're talking about really seasoned investors, and a lot of seasoned investors want to hold title in an LLC. So one of the questions that came up looks like from Alexis, is there any seasoning requirement for the LLC? Jeff, do you want to take that one?
So no seasoning requirement. The LLC has to be for investment property purposes. So that's the structure of the LLC has to be made up to hold these investment properties in that LLC. And we can have a max of 2 people in that LLC. So we can't do a group of, neighbors that are husbands and wives that are, putting their, want to take over the world and own all these investment properties, but there's 6 of them on there. Unfortunately, we are capped out at a max of 2 people in the LLC, but we're perfectly fine with that.
Yeah. Okay. So another question came up from Raul Salvador. Raul is asking, how do you calculate short-term rent in a purchase transaction? Julie, do you want to take a minute just to talk about how we look at short-term rentals and how we calculate rental rates for that?
Yeah, so what we're going to do on the short-term rentals is we're going to go off of the fair market rents on the appraisal, the 1007. Because Airbnb, VRBO, all of the short-term rentals, they fluctuate so much. So we will use the appraiser's comment on what the rents are.
Right. Okay. And then do you want to just do a quick summary of short-term rentals and what those look like, both single family and condos? Yeah.
So on single family short-term rentals, we can do that on any of our programs. For condo short-term rentals, they will be on the Dscr, which will be a non-owner property. And we'll use, like I said, the fair market rents off of the appraisal survey. We will apply a no DSCR quarter hit to the rate. The max LTV will be 75 and the minimum credit score is 700. And that's for any short-term rental property that you're doing.
Okay. Okay. All right. So and what about condo hotels?
We do not do condo hotels. If it even looks remotely like a condo hotel, we won't do that.
Yeah. Okay. So that's that's things like you have a lobby, reception area, concierge. You guys pretty much know what those look like. Okay. Alexis asked another great question. Is there any seasoning requirement on how long the person must own the home before refinancing, rate and term, or cash out? Jeff, what's our seasoning requirement for cash out?
So on a cash out loan, we will be 6 months based upon the appraised value of the property. And I'm looking at my guidelines here for this one, so I apologize. And if it's owned for more than 6 and less than 12, we do have to get a desk review done on it. Yep. Yeah, so that's the cash out version of it. Rate and term, we can do it based upon the appraised value of 6 months of ownership on there.
Okay, and Jeff, Michael Harris asked, what's Angel Oak's maximum exposure to one client?
So for one buyer, our guideline is we will do a max of 5 loans for one borrower or $3 million. So whichever one of those that you get to first. For my particular borrower that I was talking about earlier with 5, those loan amounts were relatively large. So we're doing about $3.8 million. So on an exception basis, we can look at doing something greater than that. I've done borrowers with 8 different loans. Granted, those loan amounts were smaller than kind of about 200,000 range. So it ended up being about $1.6 million worth of loans. But guidelines are 5 loans for one borrower or $3 million, kind of whichever you hit first, with exceptions available above and beyond that.
Okay. Yep. All right. Good. Julie, do you want to take a second to talk about just what the credit guidelines look like? Mortgage rates, what the seasoning is on mortgage rates, what the seasoning is on major DROGs on this product?
Yeah. So on the mortgage rate, mortgage rates, you can have 0 times 30 in the last 12 months. So no mortgage rates within the last 12 months. The revolving credit cards, loans, that type of thing, they can have no lates in the last, no 30-day lates in the last 24 months. I always explain it that credit is what we're going off of, credit in the property. So those two things really have to be solid, since we're not asking for income and employment. Right.
Okay, good. Thank you very much. Let me just see, they got a couple other questions that have come in. So Michael Steele asks, what do you mean by borrower must own primary residence? Does that mean free and clear or financed? And do you make exceptions to borrowers not owning a primary residence? Jeff, you brought this up. Well, I'll let you take that.
So you need to think of it this way, is that we cannot have a situation to where a borrower does not own a primary residence, is buying a home in the general area, and there is potential, because that borrower does not own a primary residence, for that borrower to move into the investment property that we're calling on the Dscr. We cannot put you as the loan officer or Angel Oak in a situation to where that borrower has potential of moving into that home, because now we've avoided the ATR rule, which is a major issue, and now we have an occupancy where it's truly an investment property. So the rule or the general guideline is borrower owns their own primary. I like to say that their primary home needs to be as nice, if not nicer, than the investment property, and there's lots of definitions of how we can determine that. It's not necessarily it's worth more, but the general quality of it. You can't have a guy who owns a $200,000 house and is buying a $600,000 house around the corner, because it would be too easy for that person to say, you know what, I'm going to move out of my $200,000 house because this $600,000 house is nicer, and I'm going to rent my $200,000 house. And we cannot put ourselves into that. So the guideline is you got to own your own primary residence. Primary residence needs to be as nice, if not nicer, than the one that you are buying. And we need to limit the potential for that borrower to move into the investment property as their primary residence. There's exceptions to everything. You know, I've got people that live and work in the Bay Area, and they rent in the Bay Area, but they own 3 investment properties here in Sacramento. Well, if that person is working in the Bay Area and making a Bay Area salary, and I show proof that they own homes out here already in Sacramento and are willing to buy another one, but they're still going to be living and renting in San Francisco, that makes sense. So we just need to have it make sense that the potential for that borrower to move into this new investment property is as limited as we can potentially make it.
Can I just give an example too? Is I had an investor cash flow where the borrower had previously owned a primary residence and decided to turn that into a rental and move in with his girlfriend. So he had mortgage history, he had a primary residence, now he's living with his girlfriend, he had other investment properties, so it made sense. So that's an exception that I got as well.
Yeah. So exception. Yeah, so go ahead.
Just in general, we don't want to put you in a position to where if we go knocking on that door of that investment property, and I'm not saying that we will, but there is potential that if that borrower that we did the loan for is living in that house, there's ramifications to be held, because now we've broken, kind of the ATR rule, which is a kind of a big deal.
Yeah, we looked at a loan last week, and the borrower did live with their parents, and they had, I believe it was 5 or 6 investment properties. And the property that they were wanting to purchase was an investment property that looked exactly like the other investment properties that they already owned, and we were okay with that. Those are the types of exceptions that you're looking at. If you have somebody that's living with parents and is buying their first property and they don't have any investment experience, then we're not going to lend to that borrower. But it actually brings up a good point. Julie, can you have a borrower that owns a primary and is buying their first investment property? They have no investor experience whatsoever.
You can. They do not have to have investor experience. I have had a lot of borrowers where it was their first time purchasing an investment property, and it's just such a great loan. It's so easy to do. I always kind of choke on that word, because if agency wise, non-owners are a lot more work, and this is a really easy loan to do.
Yeah, great. And Julie, while you're on this, somebody, Jenny asked, what are the fees and are there prepayment penalties on this loan?
So our underwriting fee is $14.97. That is the only fee that we charge. As far as a prepay, we do default to a 3-year prepay. You do have options to buy it out, and the pricing depends on which prepay that you do take, like a 1 or a 2 year, and you can either pay it as a fee or you can pay it as a hit to your rate. So we give you options.
Yeah. So it starts with a 3-year, and then you can actually go up to a 4-year prepay, get a little bit of benefit rate, and then you can but you can actually buy out the prepay if you want.
Right.
Yeah. Okay. Somebody, Randy Forrest, asked, and this specifically, what was the lates? Did Julie say are allowed on installment and revolving debts? From Randy Forrest.
0 times 30 in the last 24 months.
0 times 30. Okay. Okay. And
I
Jeff,
will say on that, I recently had one that had 2 30-day lates about 18 to 20 months ago, and it was, you know, a specific situation that I got a letter, and we allowed for that. Now, granted, the LTV was relatively low at 60%, so the consumer lates is something that, you know, I mean, we're obviously looking for a mortgage pattern or history with people. So again, that's something that, you know, if it makes sense, we can certainly kind of justify potentially getting around that. But that is definitely something that you'll want to, you know, keep a lookout when you pull their credit report.
Yeah. But I would never just turn a borrower away. You should have a conversation with your AE, because there's a lot of times that we know that we can get that, or, you know, honestly, I told someone the other day, I said, I know I'm not going to get an exception on that one. But, you know, have a conversation with your AE, because you never know. We do a lot of exceptions, so I think it's worth talking to them about.
yeah, I think it's an excellent point, Julie. And you know, this goes not just for this product we're doing a deep dive on today, but it goes for really every product that we originate here at Angel Oak. These are conversation loans. These are story loans. Every loan that we do looks a little bit different. And so when you have a transaction and you think that you have a good borrower and that you think is close to qualifying, then you always want to pick up the phone. We have I don't know exactly what our number, our AE count is today, but we have about 100 account execs across the country and inside in Atlanta and Miami that all do an incredible job. And whoever you're working with will be able to have these conversations, and you'll know within a day or two, and even if it's an exception, you'll know within a day or two whether or not that loan's going to be able to get done or not. And so just make sure you pick up the phone and have these conversations, because we, you know, as Julie and Jeff have both alluded to, they have their own experience of getting exceptions done on a regular basis. You know, it depends on what the exception is, but and it depends on the borrower and the situation. But have those conversations with your local account execs throughout the United States. Okay, Jenny also asked a little bit about pricing and rates. I'm going to get to that in just a minute. But Jeff, while I'm looking at a couple of these other questions that have come in, can you, one of the other features of our investor cash flow product is serving the foreign national borrower. And Jeff, do you want to just take a minute to summarize what that borrower looks like and the details of that loan?
Yeah, so if you could pull up the visual on the programs, we actually have that listed there. And you know, I'm assuming everybody on the call can read, so I'm not going to go specifically through on those. But basically, a foreign national borrower is someone that lives in a foreign country and works in a foreign country and does not have US-based income. So immediately you would think, okay, there's no chance of getting that person a loan just because they live abroad and we don't have any documented income. Well, that's not the case. So we do have the ability to do loans for them. So we are going to do them on the investor cash flow program because they are going to be required to be a investment property. So as you can see on the screen, we've got a $775,000 minimum loan amount. We've got maximum of 1.5 million. The Dscr ratio has to be at a 1.1. The main kind of, you know, when you got people living abroad is assets. So we have to have those assets seasoned for 60 days and 30 days in a US-based bank institution. So that, you know, takes a little bit of kind of planning on your part if you are planning on doing one of these. And we do require 12 months of reserves, as you can see there. And then, you know, we are going to require them to have their payment automatically withdrawn out of their checking account. And as you can see, there must have an eligible visa and everything else, no gift funds, things of that nature. So we do have that. Max LTV is going to be 70%. If you're doing a cash out on somebody who owns a property currently, it's going to be a max of 65%.
I find that the foreign national program is used a lot for people that have their children come here to go to school, or some other kind of job here, and they're buying them a house for them to live in. So I think that's the perfect reason for the foreign national.
And Jeff, I may have been distracted as you were going through that. Did you mention what the credit requirements are for this program?
So no foreign or U.S. credit is needed on the foreign national program.
Okay, so you're saying you can do a loan for a foreign national who has one of the visas outlined on this page that has no employment, no income, and no credit.
Correct.
Okay.
So this is a classic equity-based loan. So we have the exposure, our exposure at maximum of 70%. We are willing to at that LTV extend that financing out to a foreign national. So it's a pretty good deal.
And do we? You mentioned no gift funds allowed on the foreign national product. Do we allow gift funds on our regular ICF program?
Yeah. So no gift funds allowed. If that's the one of the keys. Again, we are bypassing an income, so we need to have a stable borrower on there that has their own money and is able to put the down payment and come up with the reserves and be in a financial position to support this income producing property. So no gift funds allowed on the ICF at all.
Okay. Yeah. All right. So a couple other questions. This is a great question. Another great question from Alexis Vining. She says, if a client purchases a home with hard money, renovates it, and wants to take cash out, what are the seasoning requirements? Julie, do you want to take this one? And so again, so this is they purchase it with hard money and then renovate it and want to take cash out. I think we addressed the seasoning, but why don't you address it again? And then while you're on that topic, let's also talk. Why don't you also talk about our delayed financing option, which comes up a lot on investor cash flow loans?
Yeah, it does. So it's 6 months seasoning for cash out on the investor cash flow. We will go off of the original purchase price for value. And as far as the delayed financing, if it's
Hey, Julie, sorry, just one correction. If it's been 6 months, we actually will go off the appraised value.
Oh,
right?
yeah, sorry, yeah.
Yeah, okay, sorry.
It
Yeah,
changed.
okay. Right. Delayed financing.
Delayed financing is, we do allow that, obviously, and it's treated like a purchase. So we price it as a purchase. If you are paying off hard money, I'm trying to think of what else there are examples. Sorry, I can't, I'm drawing a blank.
Hard money, private money, yeah.
Private money, yeah. You have to do that within the first 90 days.
Yeah.
If it's a standard, they just went, they had the cash, they paid cash for it, then there's not the same seasoning required. It's not 90 days, 6 months.
6 months.
Mm-hmm.
Okay, so you pay cash within 6 months. You want to get your cash back. We'll do a cash out loan. We'll treat it like a purchase LTVs, purchase pricing, no rate hit, and it's an incredible way to get money back into your pocket to possibly go buy more investment property.
Right. So don't wait on those, because if you get that little time frame and it gets down to the last minute, then it's not treated as a delayed financing. You have to stay within those time frames.
Yeah.
So I actually have 3 of those going right now, to where the borrower paid cash for it. It's a relatively small kind of condo that they were purchasing, but they paid cash for it. And in the competitive market that we have today, coming in, unfortunately, with a cash offer is going to hold more weight than coming in with a finance offer, because they can get it closed real quick. So this is a good way to pay cash within, a short period of time, whether it be 1 or 2 years. You can get a good portion of your money back, again, depending upon the scenario and LTVs and all that other FICO scores. You can get some of that money back as a cash out refi but we're going to treat it as though you did a purchase and underwrite to the purchase guidelines. So you can get the property, get your money back, or get a good portion of it back within 30 to 45 days. And now you've not only secured the property, but you got financing on it as well.
On delayed financing, you also don't have to meet like our restriction of your max cash out, because we do treat it like a purchase and you're just getting back the funds you already put into the property.
Yeah, excellent. No, it's a great option. I mean, in this marketplace, as with values continuing to go up and inventory really low, you have a lot of people that are using cash options to purchase these properties, and then getting the financing afterward, and using delayed financing is certainly one way to do that. Julie, you had a transaction. I don't know, maybe it's kind of a bit of an outlier, but you want to mention the one that just came up the other day that you got done for, I can't remember the name of the company that the borrower used to purchase the property.
Fly Home.
Fly
Yeah.
Home.
So I've been hearing more and more about Fly Home, which is a short-term loan to the borrower, and they give them the cash, right? So then they have to pay that off and rather quickly. So I had one of those, and they were getting back, I think it was 1.4 million, because that's what they paid cash for the property. So that would be treated like a purchase, meet purchase guidelines.
Yeah. Okay. All right. So we're a bunch of other really good questions, but we only have 15 minutes left. It looks like we're going to run out of time. I'm just so grateful for all these questions. We could probably do 2 hours, but we're gonna stick to our commitment of an hour. So we have 15 minutes left, and then so what I do want to do is I want to take you through our non-QM quick quote tool, so that you guys have a chance to see you have full access to this. So Jeff, I'm going to pull this up. And while I'm pulling it up, one of the other things that is really important, matter of fact, Michael asked if the seasoning requirement is a standard, say is 6 months for cash out, an industry standard. And I honestly, Michael, I don't really know the answer to that question, but I do think it's a good time to talk about the fact that it's really important who you choose to do business with in this particular market. Things are changing quickly. Jeff, do you want to just outline while I'm pulling up the non-QM quick quote tool, do you want to just outline our lock policy and how that's different from what's going on in the rest of the industry?
Certainly, yeah. I get daily phone calls from people that are doing non-QM loans right now, and with the volatility within the market, not only with the stock market, but with what's going on in Ukraine and Russia and everything else, there's a lot of uncertainty, and on the non-QM side, it is kind of coming to fruition at this point, where the rates are moving so quickly and things are changing so rapidly that there's a lot of uncertainty as far as how loans are getting locked and what the timeframes are. So our policy is at submission, at registration of the loan, we will allow you the option to lock your loan at that point if you would like to. If you want to float it and move forward, which I'm not recommending at this point, if you've got a loan and a rate that you like, I recommend that you lock at that point. But we will give you 60 days, which again, on a loan like this, these close, with an appraisal being the outlier of the kind of timing on it, I generally close these in anywhere from 21 to 25 days, somewhere in that range, assuming that the appraisal is going to come in within a week or two. But we will give you 60 days. And then if you do not meet your 60 days for whatever reason, there's a condition that you can't meet or something's going on with the property, we will give you an additional 15 days for free. So in reality, you're getting 75 days on a lock from Angel Oak, and we are standing behind those locks. We are not going to be, pulling loans out of the pipeline and all the other things that, I'm hearing out there. If for whatever reason you go beyond that 75 days, we will extend you out to 90 days, which will only cost you $0.25 in fee to extend to 90 days. If for whatever reason you have to go past 90, that's 3 months. If we can't get a deal closed in 3 months for whatever reason, we are going to have to take you back to current market rates. So basically, you're getting a 75-day lock for free with a 15-day extension at $0.25.
Yeah, incredible. All right, so let's take everybody. I think that's important to talk about as we're all moving into an increasing rate environment. the time of the lock. You know, as Jeff said, we're closing these in less than 30 days, so it's certainly not going to be on us. But if you have a borrower or something's come up and you know, things get delayed, you've got the ability to still stick with that rate. All right, so Jeff, you want to take us through? So this non-QM quick quote is, again, it's public facing, so anybody has access to this. You go to our main website, again, angeloakms.com, and then there's a non-QM quick quote tool here, or there's a little button down here, take you to the same spot. And Jeff, you want to take us through it?
Yeah, so I live by this, because the fact that, one, it's available to you 24/7, and number two, it's probably the easiest thing that you'll do throughout your day is pricing out loans. So if you have a scenario, I can't encourage you enough to go in and at least look into this to see how easy it is, because it gives you the opportunity to, if you're having a conversation with a borrower at that particular moment, you can literally price a loan while you're talking to them. And you can give them different options of, okay, your credit score is at this. What if I can get it up to this? And what does this do to the LTV? So this is one of the simplest tools that you're probably going to use. And I require my people to use this just because I think it's that easy and it's that powerful of a tool. So for the most part, you're going to be selecting the broker channel on here. There's a correspondent link on there as well, but the broker channel is going to be 99% of kind of the people out there. And then it's as simple as clicking inside the first box, putting in whatever loan amount you think that you're going to have, and then it's going to be drop downs. Literally just drop downs of, okay, here's the range of credit scores that we offer. This is where my borrower is. This is what LTV that I'm looking for. And one of the good things about the tool is that John's picked 65, which is great. But if you pick an LTV and a FICO score that don't work necessarily with our program guidelines, our pricing engine will tell you what you can and cannot do. So if you do on 90%, let's say you wanted 90% on a ICF, on a Dscr, so 90%, and then the housing history is 0 times 30. That's on their current primary mortgage. It's a 1 unit. It's a purchase. When we get to the Dscr, you're going to drop the full doc down, and it's going to say Dscr investor cash flow. And then if you click on that, it's going to say you don't have a rate. Well, you have to change the occupancy from an owner occupied to an investment property. And when you do that, it will come up with a rate. Now, as I said, the pricing engine is completely intuitive based upon credit scores and what the program will allow for. So we have requested a 90, but our pricing engine says we don't offer 90, but I can do it at 80. So here's your 80 pricing. So that's one of the things I like the best is I get calls of what's your LTV at this FICO score and everything else. And I say the pricing engine will tell you exactly what you want to hear, right? So that's
you don't have to wait for your AE to get back
right,
to you.
Right. Not that's a big issue with me and Julie because we get back to people right away, but it's all there at your fingertips. And with me talking, it still only probably took us 45 seconds to price it out. But once you get good with this, you can bounce around and be on the phone with somebody and just be pricing out loans. And then you can click through and go see the rates. It's going to give you a par rate. It's going to give you options for what if I want to get a credit for some of the compensation that I'm doing for? What if I want to do a 1-point credit? What if, you know, so it's got a lot of different options on there. And I just think it's one of the best tools out there as far as pricing goes. And that is real time and updated on, you know, our rates don't change a lot, but when they do, this is the first thing that we update. So you can trust these rates that are on there.
Okay. And so somebody asked whether or not you have to go BPC, borrower paid comp, or whether or not you can go lender paid comp, and what's the pricing that's showing up here?
Yeah, so what comes on there is the par rate, which is assuming that the borrower is paying for your compensation. So whatever that amount is, whether it be a point, 2 points, or whatever that is a par rate, borrower paying for your compensation. If you want to do lender paid comp, your company will have an agreement with Angel Oak to pay, let's say it's 2%. We have to, if you do it as a lender paid comp, we have to get to 2%. There's a lot of different ways that you can get to 2%. You can do part of it from us and part of it from the borrower. You can do all of it from us. So there's a lot of different ways. So let's say it's a 2% rate. And if you click on that view rates that's down there, it will give you the option of a 102 pricing. To do a true no point loan by the borrower would be a 102. And you would select that rate right there. And that is saying lender paid comp at 2%, here's your full 2%. This is what your rate's going to be, and Angel Oak will be paying that full 2%.
Got it. Okay. We've got about 6 minutes left, and one of the things that's really important for us to talk about. Again, great feedback from you guys on. We appreciate all the questions that have come across. This is really driven by you. But one of the things that we want to, and I'm just looking to see whether any other questions have popped up. Okay, so I think we've addressed most of them, but I do want to talk about. I want to launch a quick poll here if I can find the poll. So while I'm doing that, Julie, why don't let's talk a little bit about. I can't find that poll, but I'll see if I can find it. If you want to talk a little bit about just kind of the borrowers themselves, like where should people be looking for these borrowers? We did a little bit of a draft here, so I'll use this as the guide. Let me pull that over quick. Here it is.
Yeah, I have a loan officer that I work with who has decided to hook up with financial planners. So she gets a lot of her leads from financial planners who knows the borrower better than anyone, and whether or not, they have investment properties, a CPA. They're a great resource to, send borrowers your direction. Obviously, going through your database and looking for previous non-owner transactions, right? Title companies and hard money investors, that would be another great source, because everyone wants to pay that hard money loan off quickly. And then obviously your real estate agents as well.
Yeah, I mean, Jeff, go ahead.
Yeah, a lot of this, as I had mentioned earlier, is word of mouth. If you find somebody that does these types of loans, they are going to be in a sphere of people that also own investment properties. And I can't tell you how many loans I've gotten where we've done one for one borrower, and then that borrower referred another borrower over to that same loan officer. So you're now, just in this group of people that own investment properties, and there's potential for endless amounts of leads based upon doing one of these loans.
Yep.
Yeah. And again, one other thing that I would add, just to what Jeff and Julie are talking about, is that we do a lot of is communicating directly with realtors. One of the reasons why we think the non-QM business is going to continue to increase in volume is because the acceptance, not only from you as loan officers, has increased dramatically, but we also believe that the real estate community has also started to accept these loans as regular conventional loans because we've had such great performance, not only on closing these loans, but the way they're paying. We have a lot of people that are really, and what we would be happy to do for any of you who are partners of ours is we would be happy to present to if you have a group of realtors that you're in front of on a regular basis, we would happy to do those presentations with you. And what we find on a regular basis is that when we do those presentations to groups of loan officers, you as the loan officer walk away with transactions. And that transaction, we believe, for the realtor, we believe that you will get realtors to use you for their financing alternative. And obviously those transactions turn into relationships down the road. If you were able to acquire financing for a realtor that couldn't get it either with a bank statement loan or with our investor cash flow, I mean, what a great way to solidify a referral source than to actually do the loan for them. We just think it's a great opportunity. So just in the last couple of minutes, I do want to share with one other thing. We do have a marketing portal. So if you are an approved vendor with us, the quick non-QM quick quote tool is public facing. What we're going to show you now is only for approved brokers, and this is a full marketing portal where you get the opportunity to present yourself to your sphere of influence. And I'm just going to log in real quick. Julie, I was going to have you do this, but just because we got a limited amount of time, I'm gonna just show quickly. Okay. So we have PowerPoint presentations that are specifically for the realtor community. We have a short version and a longer version. Again, we're happy to do these with you and it really has nothing to do with Angel Oak. These are branded in your name, with your logo, with your picture. All we do is show up, and we'll be whatever you want us to be. If you want us to be your investor source, if you want us to be the underwriter, whatever you want, we will do. We even create a flyer for you to promote the event. So we have that. We've got some really cool whiteboard videos. You can come in. We don't have enough time to really get to them today, but this is just a fun way to market these. All you have to do is copy these and show them on whatever social media you want to show them on. They're there for your use. And then we have some pre-canned social media posts. These are already done. All you have to do is copy the image. We have bank statement for realtors. We have bank statements for borrowers. We have cash out refi, and here's our investor cash flow posts. You know, in any of these work we even get specific with the type of social media that you're using. So if you're using Facebook and LinkedIn, there's images here, and then we already have pre-canned, pre-written. All you have to do is copy this and post it into your social media post, and it saves you the time and hassle for doing it. And then we also have an investor cash flow for direct for realtors. So if you've got a social media that you use specifically to market to realtors, you can certainly do that. And then we also have flyers that are available. I'm not going to show that to you now because I think we've got some issues going on with that. But I will show you an example. This is an example of a loan officer that used our flyers to create their own investor cash flow flyer. Again, you can see it has the broker's logo. It has the broker's, all the broker's information. It has the broker's picture, and you can even actually download. This one doesn't have it, but you can actually download all of your equal housing opportunity disclosures that you want to put in. These are already done, and when this is working, and once you put in your information, it will save it. So you can create 20 different flyers, bank statements, prime jumbo fallout, investor cash flow. You can create all of them right at the same time. It saves all of your information. So we are actually 1 minute past. I just want to say thank you to Jeff and Julie for taking a valuable amount of time out of your day to help educate loan officers throughout the United States on our investor cash flow products. So thank you to both of you. And thank you for everybody for showing up and asking all your questions. Two things just to finish. One, if you asked a question, we didn't answer it on the webinar, we will have our local account exec reach out to you to make sure those questions get answered. And this is being recorded. So if you signed up for this, you will get a recording. And then the last thing that I'm going to show you is that if you need to find an account exec anywhere, if you are anywhere in the United States, all you have to do is click this button again, angeloakms.com, find an account executive, and we've got a full map here of where we're licensed and where individual loan officers are. So Jeff and Julie are both in Northern California. So you click on this, and this shows the AEs that exist in Northern California. But if you happen to be in Florida, or if you're in North Dakota, we have a great group of inside salespeople that cover North Dakota. You know, it's all there right at your fingertips. We appreciate your time today, Valerie. Thank you very much for hosting this. We're grateful to NAM for giving us the opportunity to get in front of your partners. So thank you, everybody. Great to be with you.
Thank you.